Thank you for coming back. I'm going to make you a panelist because I'm going to be showing your website. So we'll just hear your voice and then I'll show my screen.
Hello.
Hi, Mickey. How are you?
I'm well, Dale. How are you?
Good. Thanks for your patience and coming back to join us, and very timely time to be talking about the metals. I mean, we had a tremendous run in gold from 1160 up towards 1340 before this pullback. Even silver had a nice run. Why don't we start there, Mickey? This pullback that we're getting in the metals, to you and from what you're hearing and thinking, just a correction in a bull market? Is that the way you're viewing it?
I'm viewing it as a test of resistance.
Okay.
We went up to intraday 1345 somewhere, I think February 19th. And, you know, I went on some program, I can't remember which one because I do quite a few, and said we were going to test 1300 again. And it's critical that we do not go below that resistance. Now, I'm a supply demand fundamentals sort of guy, but you guys that do technical analysis, you know what I'm talking about. So today it's at 1305. I think this is a test.
So it could be a good buying opportunity here, and then if we start closing negatively, getting, weekly closes or so back under 1300, you get out of the way if you're trying to position yourself on the long side of gold.
Well, I would say so, but bear in mind, I'm a hoarder of gold. I'm not a trader. I don't consider it a speculation or an investment. It's a safe haven. So that's where I'm coming from. But, it was up 4.5%. This year so far. We're at a 1.5% gain right now. If you do the math from the low in late September of 1182, that's a 13.5% gain for gold market. So
and the shares finally kicked in once gold started trading above 1300. Mickey, is that because that's production costs for a lot of these miners, and until a lot of them weren't doing much until 1300 was taken out on the upside, and then they really started to kick in and perform?
Well, I really don't think so. I think it's the speculative markets.
Okay.
The major gold miners are not profitable at $1,300 or $1,250 or $1,400. They're just not profitable entities because they keep trying to grow, and we've seen that now with the proposed mega merger of Goldcorp, Newmont, and now Barrick has a hostile offer out for Newmont. If you take two bad companies or three bad companies and you put them together, it's not going to make a good company. So I'm quite outspoken about that idea.
I want to talk about it then, Mickey, because what do you think the rationale is for it? Is we haven't seen anything like this since I don't know who took over Homestake Mining, which was around for over 100 years. Barrick did it. Okay, so is it because they're looking for economies of scale, or this will reduce operation costs, or what are they saying are their reasons, and what do you think are really the reasons?
Well, they say that it makes them more efficient, reduce redundancies, lower operating costs by the elimination of G&A and redundancies in a combined company, get leaner and meaner, et cetera. Look at Barrick. 5 or 6 years ago, it diverged itself of all its African assets. And what's it done in the last 3 months? Well, it went in and bought Randgold, which is an African-based company. Now, that said, Randgold is, of the 7 major gold miners that I have studied in extensive research, Randgold is the best of the lot. It's the only one that's profitable.
What's the symbol on that, Mick?
It trades in SDRs, so
Okay.
off the top of my head, I can't remember. It's a South African-based company that
Okay.
you can buy through SDRs in the U.S.
Okay.
But here's the bottom line. Here's the problem. Um, the gold mining industry, and really the mining industry as a whole, but let's focus on gold because most of the other miners have multiple revenue streams from different metals. It's
Right.
easy to analyze gold deposits or gold companies because that's basically all they produce. Maybe a little copper, maybe a little silver. But for about the last 25 years, they have adopted what I call a Wall Street style of capitalism, which is driven by quarterly revenues and quarterly earnings. So it's a growth philosophy, and that is not compatible with the mining industry. The mining industry is a value industry, not a growth industry. You are constantly depleting your reserves, so you're faced with replacing those reserves all the time. And you look at the majors, Barrick, Goldcorp.
It's worse than being a farmer.
Yeah, and so the way that they have managed their business is growth for growth's sake, and that's not the way you build a capital intensive company. You build that company on margin. It's all about the margin, your all in cost of production, and that includes everything from initial capex to sustaining capital to G&A to dividends at all, etc. They have not been profitable since 2003. We studied them, and that's because they're trying to produce more and more ounces per year, or even sustain their production. And these major gold companies can't do that. You know, Newmont went from 8.9 million ounces in 2005. And what are they going to produce this year? 2018, around 4.5 million ounces. Barrick, the same story. It's not a sustaining business model.
They're producing half as much right now.
Right. So now
it almost makes me think, like, why mess around with miners? Because what the miners are saying, there is a supply issue of new supply coming online if the majors can't do it. So, they may have trouble as a business, but it's almost more bullish for the bullion than it is for the miners. Do you agree with me?
Well, absolutely. But here's the sweet spot in this industry. You should not invest in gold mining companies. You should speculate in junior gold explorers, because that's where the highest reward is balanced by high risk, but the lowest risk. So as capitalists, venture capitalists, entrepreneurs, whatever you want to call us, speculators, gamblers, we're looking for the highest return with the least risk. And for me, that's the junior gold explorers. That's what I do. In fact, I'm going to Toronto tomorrow, and believe me, it's not spring there yet. It's going to be about 2 or 3 degrees Fahrenheit. But I'm giving a talk on Sunday at the PDAC, which is the world's largest exploration and mining convention. There'll be 25,000 people there. I'm giving a talk as why I don't own mining companies, and it has to do with this idea that they're not profitable. You know, the Newmont and Barrick, they've all, over the last 15 years, they have done equity raises and gone into debt to pay dividends to shareholders.
So they've been trying. Yeah, they've been trying the financial engineering, the tech companies, and and it works for, it may work for Amazon and Microsoft and companies like that, but can't work for the mining industry. So they tried to put on, a high tech look to what's an old age industry.
Well, and really what they've done is it's the bean counters and their financial shenanigans. So it becomes a wash, rinse, and repeat cycle where you acquire, you pay too much after 5 years. 6 years, 7 years, you come in, you write down everything, you wipe it off out of the books, and you start over. And that's the history of the gold mining companies over the last 15 years.
I think it's so apropos because of your background that you know, above, like, say, a financial analyst who doesn't have a geological background, would be able to understand the potential of, you know, potential gold finds by some of these exploration companies. So what kind of research do you do before you go into these exploratory gold ventures to give you confidence that there's gold there? Because you know what Mark Twain said, that a gold mine is two liars standing over a hole. So,
well,
I mean,
he actually said a mine is a hole in the ground with a liar standing beside it.
okay. I know.
There's various versions of that, and it's quite interesting because Mark Twain's my favorite author. I'm from Missouri, and you got to show me. And I've studied and looked for this quote, and it does not exist. No doubt he said it in one of his rants.
That's a bought it for you.
But he never wrote it down. So he spent a lot of time in the Comstock lode. He was a newspaper reporter in Virginia City, Nevada, when the Comstock lode was booming from 1862 to about 1865. Wow. He was a coward. He fled the Confederate Army and went out west, so he didn't get thrown in jail or captured by the Unionists. But anyway, it's
interesting. I brought that up. So that resonated.
But to go back to your question, I'm sorry I got off topic there a bit. I have a tendency to do that. There's 4 critical things. You need to look at the share structure of the company. You need to, and you want a tight share structure where management has skin in the game and they've paid for those shares. They haven't just been rewarded them because they put the company together.
How do you find that out? How do you find that out?
It's all on, you can go in on, and so most of these companies are listed in Toronto Venture Exchange, Toronto Stock Exchange. So you go to something called CDAR. It's the EDGAR equivalent in Canada, and you get the MD&A. You go to a website called SEDI, SEDI, and you get insider holdings and insider trading, and you ask the companies, call up the CEO. So you want tight share structure with management with skin in the game. You want that management to be technical guys, either geologists or engineers, understand, like I do, what makes a good deposit. You want that management to have had experience in the sector before, significant experience with success. You know, someone that's bankrupt.
Like a McEwen?
Rob McEwen had one success.
Okay. Who was your favorite man?
I personally think he's lived off that success since then. Okay. That is a gold miner, and like I say, I don't own gold mining companies. I own this. I'm working an order of magnitude or 2 down from that. So
all right. So you probably have your own list after doing due diligence like this for many years of operators that have made a go out of striking gold and doing it with a good structure so that shareholders aren't, you know, sitting there and being diluted by more and more paper hitting the market so they could finance a deal.
Well, that's true. So, and you want a good project. You want a good project with good potential, and this is where my expertise comes in. And you want that in a safe geopolitical jurisdiction. So,
okay, good. I was going to bring that up. What is, in this current global environment, with things that are happening, you know, new leader in Mexico, a lot of these miners have properties in Mexico, what's happening in Latin America, what's happening in,
Africa.
Yeah,
And
Africa. Yeah, everywhere. So
Europe.
you just stick with Canadian and North American kind of properties?
I do very little in Canada. I stick with the good old Western US of A, the US, uh,
Okay.
parts of Mexico. I speak Spanish, so I've actually lived in Mexico.
Does
I
a new leader, a president of Mexico, bother you at all? I know right now he's playing nice with business, but he is pretty far left. Do you worry about nationalization from this guy?
At this stage, no. I have experience in Mexico, uh, and I can use an analogy with another country that I've worked in and lived in extensively, and that's Peru. And in about 10 years ago, they elected an avowed left wing military general socialist. And as soon as he got in, he went right to the middle. And if you looked at his 6 years in office, he was probably right of center most of the
Was
time.
that
So
Fujimoro
no,
or
no, that was post Fujimori, and that
Mori?
was Umala was his name.
Okay.
Umala.
Okay. All
Uh,
right. So you covered all the things, and I'm going to circle back to this. But I know you wanted to talk about copper, and I've interviewed a guy, and I brought it up to you when we were Skyping each other,
yeah.
that one of the reasons he's so bullish on copper is because the greenies don't want lithium in the batteries because it's so toxic, and there's going to be more copper demand. And you said that's really such a small, insignificant factor. So build the case for. I know you're very bullish, constructive copper, and we got some nice technical events that showed copper its trend changing a few months ago. So build the fundamental case for us in Dr. Copper with a PhD in economics.
Well, copper is conflicted.
Before you start, and I want to validate this for our viewers that are and listeners that are listening now, or watch it later. That well over, I've been interviewing you for a few years now, Mick, and a few years ago when copper was in the midst of a very severe bear market, and I thought the stock market would come apart because they say all bull markets are roofed in copper. Some of these expressions can get you in trouble. You were very constructive copper down there when it was in the low twos, and you said it was because of electricity generation. And you were one of the first that told me about that, the potential of copper when no one liked it. Now a lot more people like it. So what you saw when, as a contrarian, you're now getting some people to come around to your point of view. What makes it continue?
Well, yeah, copper hit a low in January of 2016 of $1.96. That's not sustainable because production comes off, supply demand fundamentals. We live in capitalistic markets. So that was a no-brainer. Here's the basic fundamentals of copper. The world population grows by 85 million people a year. 25% of those people still don't have electricity. So you cannot transmit electricity without copper. The big towers you see, those are big aluminum cables, but every transformer, every transforming station in the world has to have copper. So since 1900, copper has grown year over year with very few perturbations, annualized 3.4% per year. So just the fact that the world is becoming more electrified, we use a lot more electricity per capita now than we even did in 1990. And the population's growing, so that tells you copper demand is going to continue to increase. This idea that the Green New Deal or whatever the hell we might end up with is really immaterial to copper market. I don't care how many electric vehicles you put on the road in the next 10 or 20 years. It's not going to increase the demand for copper that much. True that an electric vehicle uses 10 or 20 or 30 pounds more copper, but if you do the math, that amounts to about even if you do the most optimistic projections for electric vehicle penetration, that's only 400,000 to 500,000 tons of copper per year. So right now, coming up, we are approaching 24.5 million tons of copper a year. So that's only 6 or 7 days worth of copper production in the world that you can attribute to the new electric generation, scenario that we're looking at.
EVs, yes. Okay.
And most of it would be electric vehicles. But the important thing is construction and infrastructure and machinery and equipment use massive amounts of copper. So yeah, that's an incremental add-on if the world does, and certainly China's going with electric vehicles. I seriously doubt if I'm going to see too many on the road in my lifetime in central New Mexico, where everybody's driving an F-250 or a big SUV. I mean, we're addicted to our big gas hogs, and I don't think that's going to change.
Mick, a lot of people are very aware of, supply disruptions when it comes to oil and energy, but haven't we recently had some problems with some very large copper mines, and can't there be a supply shock in copper because some of these mines are in areas that do not have geologic, stability, with national stability and strikes and so forth? Do you see any problems coming on the production side of copper that could actually give legs to the continued advance?
Well, certainly your point's well taken there. Supply disruption is a very important part of the copper market on a yearly basis. All the banks and all the hedge fund analysts, they bake in 4% supply disruption per year. The reason the copper price staggered and did not went from 330 last June to 260 toward the end of the year was because there were no supply disruptions last year. This year already we have seen supply disruptions, although temporary, in northern Chile, which still remains the world's largest copper producer. It's in the Atacama Desert, and there's an El Nino event, and they had massive rainstorms that wiped out some production. So that's a wild card supply. Demand balance of copper on a yearly basis very, very tight. So we're talking, 4% would be trying to do the math in my head. Again, 6 or 7 days worth of supply coming off the market. That can cause the copper price to go up significantly.
Okay, Mick, so I want to wrap it. How do people go about finding out what kind of speculative exploratory stocks, gold shares that you like? Where do people subscribe to get this kind of input from an expert like you? Because most of us aren't. So, we have to rely on somebody instead of trying to learn a new skill when the window of opportunity for these things, it could be now. How do people go about finding out what your picks and your own personal choices are and recommendations for all of the mining industry that you follow?
Yeah, I'm at mercenarygeologist.com. I am prolific. In my content, I produce on average 4 or 5 pieces a week of content, videos, audios, writings. I run a free subscription service, and to get my stock picks, you need to be a free email subscriber. You can see there on the screen right below my mugshot says free subscription. Click here, or on the right on the opposite side, subscribe to my musings. That's the newsletter. That's where I pick the stocks. A lot of content is available, but the stock picks are only available to free subscribers. We're also extremely active on Twitter. I have 52,400 Twitter followers, and that covers a variety of things that interest me. I'm a well-known libertarian. I'm a socially liberal and conservative economics. We say libertarians, you want the government to keep its nose out of your business, its hand out of your pocket. So I subscribe to that. I'm a sports fan. I grew up in Missouri, so I follow the St. Louis Cardinals religiously. So all that stuff comes in the Twitter feed. Earthquakes, volcanoes, we keep the whole thing going.
Okay, well, I'm subscribing right now. I don't know why I haven't. Okay.
I don't know why either. You missed we had 2 excellent stock picks last year. We got a triple on one and a double on the other. So
all right. Well, I'm not going to miss them anymore. I encourage people that are hearing us to go to Mickey's website. It's free. This guy, is a geologist. Well, why not take recommendations and at least consider things from someone who's not, just someone who said, oh, yeah, you know what, I'm interested in gold. He was interested in what was happening geologically his whole life. So, Mickey, you're my go-to guy for this, and I really appreciate you taking time to edify our community today. Good hunting, and may all of your investments have the alchemy of going from lead to gold.
May all your trades be to the upside, Dale. Thanks for your kind words. And sign up and see if you like what I say.
All right, everyone. That's Mickey Fulp at Mercenary Geologist. Is that correct? Mercenary Geo or Geologist. And you can follow him on Twitter and go to his website of the same name. Good hunting, everyone. Have a great weekend. Remember, don't just count your pips, count your blessings. And I'll see everyone on Monday. Thank you, Mickey. Adios.
Thank you, Dale.